We're here today on RealAgriculture.com. We're with Matthew Strauss. He is with RBC Capital Markets. He is the Senior Fixed Income and Currency Strategist. Welcome today, Matthew.
Yeah, good afternoon.
Okay, let's talk about this very, very volatile, exciting, I guess, depending on how you look at it, Canadian dollar. It's been bouncing around between par and 94 cents for a little bit of time here. What is with the volatility?
Well, this time around, it has very little to do with Canada itself. It all comes from the global environment, and to pinpoint that, we don't have to look any further than Europe with the sovereign debt issues, or i.e. the government debt concerns and government deficit concerns really start roiling the markets during the last couple of months. It was especially during the last few weeks where the market became concerned that the European authorities, whether it's politicians or the European Central Bank, that they do not really have a good plan at hand and a plan that they all agree upon to address the problems in Europe in the short term. And as a result, the market became more concerned that the problems in Europe will spill over into the global economy, dampening the recovery. I don't think at this point in time it will derail the global recovery, but it could definitely dampen the recovery, and ultimately we're now looking at a slower global recovery than what we were expecting at the beginning of the year. And with that, we saw commodity prices under pressure, commodity currencies under pressure, including the Canadian dollar, and as a result, Canadian dollar selling off quite dramatically during the last few days.
So can we expect this sort of trading pattern or extreme moves to continue to through the next 6 months?
Maybe next 6 months, a bit of a long time frame. However, I think during the next few days or even weeks, I think volatility will be very much with us, because currently it's clear that sentiment is the overriding driver of markets everywhere, including then the Canadian dollar. And we know that sentiment can change on a dime and generally quite fickle. As we've seen earlier in this week, really fear and panic setting in, and now at least at the end of the week making way for some semblance of stability, but any major development, or even not that major development, could change sentiment once again. So as long as sentiment continues to remain the dominant factor, one should expect some extreme moves on the currency side. We think that within a few months, other factors, underlying commodity prices, and more importantly, underlying fundamental factors within Canada, will start playing an increasingly important role in driving the Canadian dollar, and we should see slightly more stable ranges and strengthening bias in the Canadian dollar.
So we can expect your outlook is that we can expect to be closer to that par in the short term.
Yeah, I think if we now talk on 3 to 6 month horizon, parity is very much still a possibility, although parity this time around will probably be slightly more difficult to reach than what we've seen earlier in the year, because we know that investment funds and corporates will probably start buying their Canadian dollars before we reach parity. So that in itself could be a bit of a hindrance for the Canadian dollar to go right down to parity. But we do think that we will be trading much closer to parity in 3-6 months from now, and maybe even with a brief visit above parity.
Yes, we've talked about the situation in the EU really pushing the volatility in the dollar around. Is there any other factors that people should be looking at to get some sort of indications in the shorter long term that could be driving the dollar in either direction?
I think in the short term, unfortunately not. The sentiment and the developments in Europe will continue to dominate the headlines. However, the moment if we start looking over the medium term, I think Canada is very, very well placed to actually outperform all currencies. If we look at the domestic environment, our data that came out during the last few weeks, all not only strong, but much stronger than what the market was expecting. Starting off with numbers like the employment data, much better than expected, and then a number of the activity data, with its retail sales, wholesale sales, manufacturing sales, all very strong numbers, suggesting that we would probably see economic growth even higher than the 5% quarter-on-quarter growth that we saw in the fourth quarter. So that this is first part of 2010 from a domestic perspective looks very strong.
So right now, how is the Canadian dollar being viewed by international investors? Is it looked upon as a strong currency?
Clearly, before the European problems really came to the fore, it was considered one of the best commodity-based currencies and a structurally sound currency. And we saw and heard about central banks starting to move into the Canadian dollar as part of their global diversification. So it was already one of the preferred currencies. Then it was now interrupted by the European crisis. But as I said, once the dust settles, we do think that interest in the Canadian dollar will very quickly return.
So we've established that we can expect the volatility in the short term to continue as long as the concerns are out there about the EU. We can expect that in the 3 to 6 month time frame, par has a potential to be reality. What does the bottom end of that range look like in your mind?
I think just below parity would probably be the bottom end. If we currently look at our own econometric models that's trying to put a theoretical value to the Canadian dollar, it is rough. And if I just round the numbers, we're basically looking between 90 cents and just above parity.
Yeah.
So that's where fair value would be for the currency at this point in time. So as long as it continues to trade in the 90s, high 90s, or just above parity, we would not be uncomfortable with the level of the Canadian dollar.
Yeah. So as a for example, as a person that's running a feed yard and you're exporting fat cattle to the U.S., maybe want to take advantage of those opportunities where the dollar does get closer to 90 cents to lock up some of your dollars.
Absolutely. I would actually say anything from 94 or lower. Exporters should seriously consider to take advantage of those levels.
Well, Matthew, thank you very much for joining us today. I encourage everybody, if you have any more questions about the currency market or interested in taking care of some business there, to contact RBC Capital Markets. And Matthew, thank you very much.
My pleasure.